Now, our next speaker is a returning speaker to the SKAGEN conference, Chen Zhao from Bank Credit Analyst, BCA. I'll first tell you just a little bit about Bank Credit Analyst and then present Chen Zhao. Bank Credit Analyst has existed since 1949. They are based in Montreal and they have offices around the globe. One of the things that's special with Bank Credit Analyst is this is truly independent research. It's not kind of independent research. It's not, to put it a little sarcastically, it's not, even though I'm paid by an investment bank and trading activity, I also have to maintain my own credibility as an analyst, so I'll pretend you the truth somehow. I mean, some investors are skeptical about sell-side analysts. We think it's important to have truly independent research that is financed by clients paying for it. Clients paying for it. Bank Credit Analyst has a strong track record in many ways, and one of the guys who have built it is Chen Zhao, who's been with BCA since '92. Started, of course, as you can imagine, with a China publication, and in 1998, you also had a publication trying to promote the idea of emerging markets. To flatter ourselves, we were a few of the crazy people who went into emerging markets back then. There are also strong investors from Copenhagen who bought Samsung back then, but it was a very hard sell. Now, from 2005, you have been global editor of the Global Investment Strategy of Bank Credit Analyst, which is a flagship publication, and we are pleased to have you here. Welcome, please welcome Chen Zhao. Best of luck.
Thank you very much for the very kind introduction. Actually, my time is up. Anyway, what I'm going to do is to run through some of the key themes. I know that I think lunch is about ready, so I don't want to hold you guys here for too long. Well, just talk about the Japanese demographics. Actually, there was some stunning statistics. I think I'm just sort of adding a little bit of flavor for what you just said. The sales of adult diapers today in Japan exceeds the sales of baby diapers. That's true. And also, you know, when you talk about that, you know, the Chinese are not particularly fond of the Japanese. They hate each other, actually. So some of the Chinese actually told me that, well, you know, the demographic will solve the problem. I said, what do you mean? Well, the population decline 1% every year, so in 100 years, there'll be no Japanese left. They'll all be dead, so we don't have to worry about them. But anyway, what I will do is to run through some of the macroeconomic stories, and I will try to relate that macro story to investment implications, meaning I will be very practical. We try to figure out a way to make some money, or at least trying to figure out a way to lose a little bit less, okay? Looking into this year, what will be the key macroeconomic themes? I think there'll be three very important macroeconomic stories that will dominate the global financial markets. Number one, if you think about the world economy over the last 4 to 5 years, it is highly unusual. Why it is highly unusual? Well, if you look at the post-war period, most of the time, the world economy has always moved in sync. If we have expansion, the global economy, major economic blocks are always in an expansionary mode. If we have the recession, everybody going into recession. So they are always more or less in sync. But that's not the case for the last 4 or 5 years. If you think about the United States, the US economy has been incredibly steady. Slow, yes, no question about it, but very steady, moving along the path of 1 to 2%, despite of the fact that we had quite a few period or episode of instability, fears and concerns and trepidation, whatever you want to call it. Nonetheless, the US economy has been very steady, 1 or 2%. Now, if you go to Europe, the European economy has made a classic double-dip recession. The first down leg took place in 2008, 2009, followed by a very brief recovery in 2010, and another big down leg after that. So that's Eurozone. Europe as a whole, double deep recession. Now, if you go to China, the economic profile of the Chinese economy is totally different from everybody else. 2009, 2010, we had a massive growth acceleration on the back of that humongous fiscal stimulus. Everybody knows that. And then after that, the economy, the growth basically peaked in 2011, and then we have had a very pronounced deceleration afterwards. That's the Chinese economy. Huge wish up, a pronounced deceleration. That's the profile of the Chinese economy. I don't want to even mention about the Japanese economy. This is pathetic. It had 8%, not because I'm the Chinese, but I'm just stating the fact. The Japanese economy had about 8% contraction. And in 2011, just about the time when the economy was about to recover, it got whacked by this tsunami and nuclear disaster, and that just dead right there until very recently. So that's Japan. So as you can see, we have been all over the places. It's very unusual. Now, the reason I'm mentioning that is that this year will be the first year in a long while that we're going to see some resynchronized global economic expansion. It is very easy to see the US. Just do some number crunching here. Last year, the US economic growth rate is about what? Slightly below 2%. That was achieved in spite of the fact that you have taken away 1.5% from fiscal drag. So this year, the drag is gone, you add back, you can see why growth could be 2.5%, 3%, or even 3.5%. Just pick a number. It's going to be close to 3% if you are cautious. If you want to be wild, it could be 4%. I mean, I don't know. This is going to be a whole lot better than last year. The Chinese story is a hard story to tell, but I think the Chinese growth probably bottomed, in terms of growth rate, bottomed probably towards the third quarter of last year. Right now, if you look at the transport volume, electricity consumption, the typical stuff that is actually basing out. Very important. Now, the Eurozone. If you look at the chart here on your right-hand side, don't ask me how this model works. I don't even know, but it works. The model basically says the Eurozone contraction is ending as we speak now. We will have some positive growth. I don't think it's going to be strong, but I do not care. The reason that I do not care is this. The size of the Eurozone economy is almost as big as the United States. As long as contraction coming to an end in that part of the world, the contribution to global growth on the margin is going to be huge. So that is a positive thing, as long as this model is right. Trust me, it is always right. Now, if you look at this chart here, this is global industrial production. It's manufacturing activity. If you look at again, the red line is our model prediction. The blue line is the actual number. Actually, we might go into some kind of a mini, I wouldn't call that mini boom, but it's pretty robust growth going forward. We're probably talking about better than 5% expansion. That is quite something, okay? So all I'm trying to tell you is that you have to remember the first theme of this year is global resynchronization. That's the number one macro story you should keep in mind. The second macroeconomic story you should keep in mind is economic restructuring in Asia, Japan and China in particular. These are very fascinating stories because the Chinese reform focuses squarely on supply side, where the Japanese reform focus on demand side. So we have two biggest economies that have engaging in very aggressive reform, but with completely different focus. Now, think about Japan. People keep asking me, the Shinzo Abe got about 3 arrows, so he shoot first, and then how about the second, third, and fourth? Don't get it too complicated. There'll be so many arrows. There is only one mother for all arrows, which is called monetary reflation. Driving down the yen, that's the story. Actually, most of the time when I said that, people were asking, oh, will that resolve the Japanese problem? And then I thought about this question. I said, that is a fair question. But I'm not quite clear what he meant. Normally I ask, well, what do you mean by the Japanese problem? Well, if you look at the last 15, 20 years, the Japanese economic growth is about 1%. I mean, pretty lousy in the industrialized world. Well, when you think about it, it sounds intuitively correct. But if you think it through, it doesn't add up. Why? Let me tell you this. If you adjust for population growth, which is minus 1% per year, per capita GDP growth in Japan is 2%. Now, if you think about the United States, the average GDP growth, real GDP growth over the last 15, 20 years, 3.2. Population growth, the average growth rate is about 1%. So if you adjust for labor force, your productivity growth in the US, your per capita GDP growth in the US is about 2.2%. Japan's about 2%, US has got a 2.2%. You're gonna ask yourself, what is productivity growth? I'm sorry, what is per capita GDP? Per capita GDP is productivity. Per capita GDP growth is entirely explained by productivity growth. So that basically tells you, in Japan, there's no productivity issue. The Japanese populations there are almost as productive as the United States. They're not like Greeks or Italians who do not work, they do work. Sorry if there's Italians, I don't want to offend anybody, but I'm just saying, there's no productivity issue in Japan. If you look at the corporate profitability, I'll give you a number. I'm not lying, just take it as I'm honest. If you look at past 15 years, since 2001, the average growth rate of corporate earnings in Japan is about 8.1%. In the US, 7.8%. So the Japanese company is almost, well, actually, it's more profitable than the US counterpart. So I'm saying, when people saying, will Abenomics resolve the Japanese problem? I say, well, first of all, you got to define your problem. The Japanese economy does not have a productivity problem. The Japanese economy does not have a profitability problem. The Japanese economy has a deflation problem. Deflation is a big problem. They've had it for years. What you say? Well, what is the problem? Deflation, 1-2% decline every year. That's okay. No, it's not okay, because if you have sustained price deflation, you twist your incentive structure of your economy. Because if everybody knows that the price will always fall, then nobody want to be investor, nobody want to be borrower, everybody want to be saver, everybody want to be creditors. That's the Japanese problem. The Japanese problem is that because of sustained decline, the private sector always save a lot of money. That's why you see the Japanese government debt is going through the roof. Why? Because nobody want to spend. Everybody want to save. The government will have to go in, borrow the money, and spend for the private sector. That's precisely why we have this high level of debt. I think Abenomics will work. Well, I'm sorry, I don't want to say that. I don't know whether Abenomics will create sustained inflation. I have no idea, to be honest. But I don't care, again. What I care is about the process. They are trying to generate inflation by driving down the yen. That's where we're going to make money. That's the second. Well, I will not spend too much time on the Chinese supply side reform. I think the Chinese supply side reform is very real. I think it's I feel very bullish. What they are doing is right thing, because most Chinese, if you ask them, there's a huge amount of dissatisfaction for the last 10 years. They call the last 10 years as a lost decade in terms of advancing market reform. No question, the growth rate was fantastic over the last decade, but in terms of economic restructuring, the previous government didn't do anything at all. If they did anything, basically they regressed a lot of reforms that were put in place in the 90s. For example, if you look at the central government revenue, basically the Beijing government has re-centralized the tax basis. They allow the state monopoly to become humongous. They basically adopt a whole range of populist policy. They bump up all those minimum wage. They impose a lot of burden on small business. I don't want to go through, it's really bad. In terms of economic policy, the previous government was very bad. This current government, I think they have already announced 64 measures of reforms. 38 of them are being carried out. People say, why are you so bullish on this government? I say, the reason is very simple. The current president of China, he's a son of a bitch. Again, I hope there's no spy from China, but the reason you need a son of a bitch, you need a tough one to really cut through the vested interests, and he is the guy. He will do it. He can mark my words. He will cut. He will do it. He will do what he say he will do. That is bullish long term. But the short term, I am not quite sure. But we're going to get there from investment point of view. How do we make money out of this? So I will talk about that later. But that's the second macroeconomic theme. Supply side reform in China, demand side reform in Japan. That's the second macro theme you have to keep in mind. The third theme, the third macroeconomic story, I think will continue to play out, is the fact that we're very close to a generalized decline in prices. I totally agree with Paul Krugman's assessment. I think the world saves way too much, invests way too little. I just did a very simple count. Out of 22 industrialized countries, 20 of them have inflation rate that is below 1%. Well, if you have 1% inflation, you don't know whether you have deflation or inflation. You are within the statistical error. You don't know, meaning extremely low. If you look at this chart here, we know the Eurozone deflationary case. Well, let me explain this chart here. The red, you see the stunning thing is the red line in both charts. The red line here is the so-called diffusion index. It is basically taking the basket, the components of CPIs. You measure the different items. You measure the prices of different items that is going up versus going down. When the curve collapses, it means that there are more items in CPI basket that prices are falling. As you can see, the Eurozone will go into deflation. There's no question in my mind. It's a classic dilemma between devaluation and deflation. You cannot devalue, you got to deflate, period. The reason I'm plotting UK, which is on your right-hand side, is that UK is always considered as most aggressive monetary reflator. And most of people actually, whenever you think about UK, you always think about UK has higher inflation. Actually, if you look at the diffusion index in the UK, the inflation there is going to blast it down pretty quickly. So in other words, we are dealing with for the first time in a long while, I think since the end of the Second World War, we're dealing with realistic possibility of a generalized price decline, or at least very, very low inflation. So to sum up, three major macroeconomic stories everybody should keep in mind. Number one is growth resynchronization, at least for this year. Number 2, supply side reform in China, demand side reform in Japan. And number 3, very low inflation coming, or possible deflation. That's the 3 macroeconomic story. Now, the question comes, this is the practical part. So what does this mean? How do we make money out of this macroeconomic story? I can see everybody's eyes start to open up. Good. Now, it means a couple of things. It means a couple of things. The first thing that I can think of, you're rest assured that I'm going to give you some very concise and clear bet. The first thing that I can think of, if you look at this side, if we have global resynchronized economic growth, corporate earnings will re-accelerate. If you look at the US corporate earnings growth, that's why I don't agree, I do not agree with the, not this speaker, the previous one. She basically said that the profit, the bull market is artificial. I don't agree. We had an enormous profit expansion. The profit went through the roof from 2009, 2010, and then we had a very sharp slowdown in earnings growth. Last quarter, the fourth quarter of 2013, it slowed down to about 2 to 3%. But now, if we get global resynchronized growth, my model, again, don't ask me why, but that's my model, will basically telling us that the earnings expansion we're going to quicken to about 20%. Right now, the market has discounted about, what, 13%? I think my model is doing, my model is probably telling us that we will probably do better than expected in terms of earnings. That's the first thing, obviously, very bullish for stocks. Number 2, if we get some resynchronized growth, the second implication, very important one, is that we will see further steepening of the yield curve. Or at least the yield curve will stay very steep for obvious reasons, because the yield curve is the best predictor of the world, of the economic growth. It also tells you the current monetary condition. If you have an easy monetary condition, better growth prospect, the curve will steepen. The interesting thing is, if you look at the blue line, which is multiple, which is equity PE ratio, forward PE, equity multiples are positively correlated with the steepness of the yield curve. Again, for very simple reasons, if you have a steepening yield curve, you have a better growth prospect, better profitability. You know, usually when you have a steepening yield curve, it tells you the monetary condition, current conditions is very stimulative, and of course, it's very conducive for earnings, for multiples to expand. Now, there's a critical issue, which is, are we already in the equity bubble or not? There's a lot of question about that. My sense is, no. We are probably fairly valued, but I don't think we're in a bubble yet. Why? If you look at this chart here, let me explain what this is. The first chart here, you have 2 lines. One, the blue line is S&P 500. The red line is earnings. So the story here is a very simple one, an intuitive one. I decompose this bull market into 2 phases. The first phase is really from 2009 all the way towards the end of 2012. During that phase, earnings expansion far exceeded stock price appreciation. As a result, you had a multiple contraction. That's the second panel here. For reasons that is very obvious today, because we had a fear of US double-dip recession, we had a fear of Eurozone breakup, the whole range of things that bothered us for the last couple of years. So the first half of the bull market, we had a multiple contraction, and only when Draghi came out saying he will do whatever it takes to defend the euro, the multiples start to expand, i.e., stock prices have begun to increase at the rate that is faster than earnings. Okay? So for the entire duration of this bull market, we have not had sustained, progressive PE inflation. Today's PE is sitting right at the level when the bull market was about to start. So that's the first thing that I don't agree. I don't think we are in the bubble yet, but if we have further multiple expansion, as I expect we will get, then we may start to have bubbly equity markets, but not today. Well, of course, there's a whole bunch of valuation index. And I don't want you to pay too much attention to that. It's just for fun. I mean, depending on which index you're looking at, you can tell any story you want. But if here is probably fair value, here is, but that's all. The valuation doesn't tell you anything in terms of turning point. A market can stay under or overvalued for a long period. The entire 1990s, we see very overvalued stocks. So what? So the bottom line here is multiple expansion. That is an inevitable conclusion that comes from the fact that we will have synchronized growth, but very low inflation. The Fed, the central banks, there'll be no way for them to even think about raising interest rates this year. So that basically creates a fertile ground for asset price inflation. Actually, the Fed has almost said that explicitly. They want to have asset prices that is going up. Because we are in a liquidity trap. Once you are in the liquidity trap, higher asset value is the only way that you can transmit the impact of monetary policy, because the so-called wealth effect. Okay, so that's the second implication. The third implication, if we have some resynchronized growth, we will have a sustained decline in market correlation. You can see that from there. Equity bond correlation have already broken down. You can see from here, the equity commodity correlations have broken down completely. I mean, if you think about over the last 4 to 5 years, there are only one trade. You either bet on risk on or risk off. There's no real choice of portfolio diversification. That's not existent. The reason is if you bet risk on, you buy stocks, you buy commodities, you go short the dollar, you sell bonds. If you bet risk off, you buy bonds, you buy dollar, you sell commodities, sell stocks. That's it. But these market correlations are undergoing a very dramatic change. Actually, if you look at the intra stocks within S&P 500, the correlation has fallen to 15-year low. It's quite dramatic. So for the first time in a long while, we do have a choice of asset diversification, not only across different asset classes, but also among stocks. So probably next year you don't need me. 2 minutes? 5 minutes? Oh, okay. Sure. So I'm going to go really quick. Now, that's the third implication. The fourth one, I think that this year you have to be long you have to be long Japanese stocks. It's very simple. If you look at Japan's equity market performance in common currency terms, since 2001, basically it's dead flat. This is common currency Japanese equity market performance relative to benchmark. Okay? It basically tells you that the decline in the Nikkei index has been entirely made up by the yen's appreciation. Basically, if you invest in Japanese stock, there'd be no difference whether you invest in U.S. stocks or invest in the Japanese equities when you measure the returns in the dollar. It basically tells you that Japan's problem. The Japanese problem is that the Japanese authorities have allowed currency appreciation to depress domestic nominal variables. domestic prices, including asset prices. But on the whole, it's the same thing, because the profitability of the Japanese companies is about the same as the United States. That's why the equity market performance, when measured in the common currency terms, is about the same. So the key point here is, if they are serious, I think they are, to hit 2% inflation target, that is the blue line, then the yen, which is the red line, the trade-weighted yen, has to drop more. How much more? I don't know, maybe 120, 130. The only problem right now is that everybody sort of look at the yen, everybody figure out the story. There are too many short positions being crowded, jammed in the market. But I think that very crowded short position is being worn out pretty fast. I think at least for a 12-month period, you should be long the Nikkei and completely hedging the currency. Easy to do. Finally, if this low inflation story plays out correct, be careful. Don't be too bearish on bonds. The whole world is short duration today. If you think about a 30-year yield, close to 4%, it's, I think, already in equilibrium. The US nominal GDP growth for the last 4 or 5 years has averaged about 3.6. 30-year yield gives you 4%. Very well compensated by holding it. If you hold 30-year, you're very well compensated. The average term premium between 10-year and 30-year from 1960s is about 16 basis points. So in other words, 10-year, we still have further to go. 10-year, you still see the Fed manipulation. 30-year, you don't see it. Longer end of the curve, you don't see Fed. You move towards the shorter end of the curve, you see more Fed. So I'm not bearish on the 30-year. I think 30-year got value already. Emerging markets, don't touch it now, because this thing goes by decade. If you think about it, every decade there is a theme. 1970s was inflation, that was the key theme. 1980s, that was Japan rising sun, that was the key theme. 1990s, that was the technology, everybody was crazy about it. Last decade, it was China commodities. That story is over. It won't be another driving force. So emerging markets, so give it for another couple more years of doing nothing, and then I remember one thing clearly. I created our emerging market product in 1998. I traveled around the world trying to sell the thing. Nobody wanted to talk to me. Basically, everybody told me that they just shut down the emerging market team. They never, this is, Chen, tell me something else. I don't want to talk about emerging markets. In hindsight, that was the rock bottom. I don't think we're there yet, but 2 more years of underperformance in bad markets probably will bring us there. At that time, you probably think about it. But anyway, my time is up. Yeah. Yeah?
We're going to do something.
Sorry for the, probably you guys are 10 minutes late for the lunch, but anyway.
Well, yeah, could have been the lunch. We have some backup microphones. Feels a bit like playing music, but it's not. We'll go a bit unusual and promise you when you have some burning questions for Chen, please pick up a SKAGEN employee and we will see what we can do in the afternoon. The whole team goes to Stockholm after this conference. Means you will be here, but please allow some lunch. And we will see what we can do. As for now, we will go for the emerging markets model we heard from Dambisa Moyo, and we will prioritize food instead of liberty and questions. Thank you so far, and 40 minutes lunch break.
All right.